Hello, and welcome to the Argyle CFO Leadership Forum. My name is Nick with Argyle, and it's great to have everyone joining us today. A couple of notes before I turn things over to our esteemed speaker. First, a quick reminder to stop by our sponsors' virtual booths at any time during today's event and for the following week. Our partner is committed to providing you with valuable content and a great overall experience. At any time during today's event, you can visit their virtual booths from the main agenda page, which include complimentary materials, information, and meet and greet opportunities. To ask questions throughout the session, simply type into the Q&A chat, and we will address your questions at the end of the session. Now, without further delay, I would like to introduce our speaker, Nayab Siddiqi, Chief Financial Officer and Head of Strategy, REZY360 Inc. We're super excited to have Nayab with us for a keynote presentation titled Budgeting and Managing Cash Flow for Success. Welcome, Nayab. Over to you.
Thank you. Thank you, Nick. Hello, everybody. As Nick has introduced me, this is Nayab Siddiqi, Head of Strategy and CFO for REZY360 Inc. I'm based out of California in the San Francisco Bay Area. I have been in the finance field for the last over 25 years now. So our company, REZY360, we are a technology company focusing on human interaction, activities, and reward systems, primarily running a platform, a community platform. So that's what we do. So happy to be here and talking about a very important topic, which is budgeting and managing cash flow for success. Given the short period of time for the session, we'll keep it at a strategic level, and I look forward to looking at your questions, and I'll be happy to answer those at the end of the session. So without further ado, let me jump over to the topic. So the different topics that we are going to touch upon during the session, we'll be talking a little bit about our budget, about budgets and projections. How do they interact with each other, and what are the differences? We'll talk about cash flow management and its importance and how to do it right. We'll also talk about the best practices that we can follow while creating our projections, and how to build reliable projections and how to effectively communicate that. So this is sort of the high-level introduction of what we are going to talk about. Let's talk about our first item, which is budget and projections. We all know, and it's a very renowned saying, that if we fail to plan, we are actually planning to fail. Which means if you're running a business, be it an individual endeavor, our own lives, if we don't plan for the future, we are setting ourselves up for failure. And that's what the segue to this session is. Talking about two very important aspects. One is budgeting, the other is projection. Whenever we talk about future, we talk about, have we budgeted this? Have we looked through it? And what does our budget look like? We always talk about, have we projected this for the future? How we are forecasting it? So future always have these terminologies whenever we talk about our business results and looking through the future. So, and these words are used interchangeably. They are interrelated, connected, but not the same. So I just wanted to highlight a few differences and points that we need to consider while talking about budget versus projections. So if we talk about budget, it's basically an estimate over a specific period of time, always looking through the future. It actually reflects through the financial goals and conditions and outlines the intended direction, which means budget is something that we intend to do. Of course, it takes information from what we know of our own business, the internal, external factors, but this is what we want to do in future. So it's mostly goal-driven and our intention-driven. Generally done on an annual basis. It quantifies our financial targets, and of course, it's a tool for us to stay focused. Whereas projection, basically projection, if you look at it, it flows through into the budget most of the time, but that is more detailed, and it's more, it can be, for a longer period of time. Again, it's a long-term prediction, not necessarily for 1 year as we normally do for budgets. Projection can feed into our budget as well. So, and then analyzes both quantitative. We analyze both quantitative and qualitative data while developing our predictions, internal data, external data, whatsoever. And then it also talks about market trends. It bakes into executive insights, analyzes our financial non-financial information. So very interrelated, looking through the future, but they're not the same. And what are the benefits of using them? Of course, if we don't do our budgeting or projections, if we don't do forecasting, we'll not be able to do resource allocation the right way. Our performance monitoring, they help us with performance monitoring. They help us with risk management. So at a very high level, this is what we should expect from our budgets. This is what we expect from our projections. Talking a little bit about cash flow management, which is the key topic for this session. We all know cash is the king. We keep saying this every day. And rightly so, because if a company is not managing its cash right, it's setting it up for failure. So it's not wrong to say that cash flow is the lifeline for a business. If you are not managing it right, the business would be doomed. So when we are projecting for cash flows or projecting our cash flows, how does it help? Of course, we are looking through the financial health of the business. So cash flow forecasting helps us identify periods of cash shortfalls, surplus, helping us with proactive decision making. And basically what happens is that we are actually looking at the troughs and the crests in our cash flow or our business activities by doing a robust cash flow analysis or cash flow projections. Once we look into that, only then we'll be able to plan for our investments. Any surplus cash, how long are we going to invest that for? Is it going to be a short-term investment, a long-term investment? We can't have those decisions or come to those decisions unless and until we've got a very robust cash flow projection and a good understanding of our cash flows and when and how they are going to generate and where they're going to be utilized. Most important factor is working capital management. How much inventory do we want to maintain? What is our payment cycle? What is our cash retrieval cycle? How much are we going to invest? Where the financing is coming from? So unless and until we don't, do a robust cash flow management or cash flow forecasting exercise, we are not going to, understand our working capital. We'll not be able to manage that. So it's very important to do our cash flow management and do a forecasting exercise and keep doing it all the time. It's a rigorous and it's an ongoing process. Talking further about cash flow management, I hope a lot of attendees right now, they might come from the finance background, and we all know about our cash flow statements. We always talk about three key elements or three key sources of cash flows: the cash flow from operations, investing and financing activities. So nothing new, but I just wanted to highlight one thing over here, which is very important, that a business cash flow normally basically depends upon its operations. So if the cash flow from operation is not strong and we are not giving a laser focus to our cash flow from operations, investing and financing activities are basically an outcome of our cash flow from operations. So a laser focus on this, most important factor to consider when we are creating our cash flow projections. And when we are doing so, of course, we are going a little bit deeper into each and every element. How much income we are going to generate? What is the timing of that income? When is that money coming in? How much expenses are we going to incur to earn that income? What is our working capital cycle? What is our order to cash cycle? What is our procure to pay cycle? How much inventory we are maintaining? When are we paying our vendors? How much time our customers are taking to pay to us? That's all what's generating cash flow for us from operations, and that's the cash flow that is going to be invested in other avenues to earn future income, and which means cash flow from investment is actually an outcome of cash flow from operations, because operations is actually what the business is doing. And a lot of times companies fund themselves through cash flow from financing, but that is, again, as I said, an outcome of our operational activities, cash flow coming from operations. If we are not generating enough cash from operations, we tend to go out and seek for either equity or debt financing. So laser focus on operations. That's what I wanted to highlight. Let me move over to the next topic. Projections and best practices. Right, there are some questions coming up, but I'll leave it to the last. Thank you for putting it over here. Yeah, I can see those. I'll answer those questions at the end of the session. Let's talk about projections and what are the best practices. As I earlier said, projections, forecasting, budgeting, this is all futuristic activities. This is a peeking through the future, understanding what the future entails, which means our focus should always be in the future. It's just like I always use this analogy of driving a car. When you're driving a car, you're actually always looking ahead, but sometimes you look back as well. You look through the back view mirror and see what happened, what's coming behind, right? This is exactly the same analogy that applies on our forecasting or projection, creating a projection exercise, where we are focusing on what comes in the future, how we want to navigate through the future, but at the same time taking information from all the historical learnings, all the historical data that we saw, and then making use of that experiences and projecting our future based upon that information. But at the same time, we don't take our eyes away from what comes next. What is it, where the turn is coming, where a new, turn in the business environment is coming up. So future is important, and looking back into history is important as well, but keep yourself focused on future. Again, talking about best practices, I put it into 4 buckets, or I talk about best practices in terms of 4 quadrants. And those 4 quadrants are actually information, collaboration, assumption, and technology. We can't forecast, we can't create our projections unless and until we don't have information with us. Information is the key. Without information, it's not possible to create projections. And when we talk about information, it's not just one type of information. We need internal information and we need external information as well. We need historical information and we need futuristic information. So it's like 360 degrees view of the information that we gather from different ends. A lot of times, I mean, in my experience, I've seen that when people are creating their budgets or their forecast, they mostly look at their historical information and try to extrapolate that to future by applying a certain percentage, adding a few assumptions, and based upon that extrapolating into future. It works, but this is not exactly the right way of doing it, because this means that we are keeping our eyes blind and we are not looking through the future. So from that perspective, I always advise, always look to the future, always see what's coming up. What are the market developments that are happening? If you don't bake those into your forecast, you're setting yourself up for failure. What are your internal targets? If you're not looking at your own targets and just applying a certain percentage based upon your historical trends, which means you're not doing the justice to your projection exercise or forecasting exercise. We always need to have understanding about our business needs. Always look for legislation. There's a new legislation coming up and we don't know about it, and it's going to impact our business. If we don't have that understanding, ultimately we are not incorporating that into our projections. Our projection will go for a toss once that legislation comes into practice, and our numbers go for a toss. So information, every type of information, and make use of that. Secondly, collaboration is the key. It's not an exercise that can be done in isolation in a single room. A lot of times, our brother people from finance, people think that it's only finance job to do projections. It's not. It's basically a teamwork where all the different functions, all the different departments within the organization collaborate, contribute, and provide information and provide insights. And based upon those insights, normally finance teams build those projections. So it's a cross-functional exercise. It's not one function, one finance function doing it all. Always give yourself sufficient time, because gathering all this information, collating, consolidating, coming up with understanding of different factors, it takes time. So always give yourself sufficient time. It's an ongoing process then. It's not a one-time process when you create your projections and then you just present it and put it somewhere and then come back after a year's time or 2 years' time. It's a continuous process. It's an ongoing process. You just like keep talking to each other, keep getting data points, keep adjusting your forecast. Something new comes up, a new legislation comes up, a new vision comes up through the top management. Keep baking that into your assumptions, and that will create a robust projection or forecast for you. Standardization is important. Your templates, I mean, just imagine you're going to a sales team and verbally asking them, hey, how does your sales cycle look like? And then taking some notes and coming back and baking that into, and tomorrow you go to another person, the person leaves and you're talking to someone else. That person has got altogether a new understanding, a different understanding. So verbal description, verbal discussion is important to understand, but always use standardized templates so that you're following a structure. KPIs are extremely important. If you understand a KPI differently versus the business organization understand it differently, it will create a lot of friction. It will create a lot of misalignment between functions, and your forecast, your projection will go for a toss. So always look for the right KPIs, how we understand versus how the business understands those KPIs, and what makes sense, what is important for them. Is not only what's important for us as finance teams or finance leadership team. It's what is important for the business. So look through their lens. Talking about assumptions, that's the fifth and one of the most pillars. When we are talking about future, nobody can predict the future. We all try to predict the future based upon our learning, our understanding, our knowledge, our experiences, what we hear from others. And which means when we are talking about future, we are always taking assumptions. How good are those assumptions? That all depends upon what kind of knowledge we have, what kind of information do we have, and our insights. So our projections are based upon key assumptions. Always build those assumptions, always document those, and see how those assumptions are going to impact your projections and forecasts. Look for interdependencies. A lot of times, again, out of my experience, a lot of times we look at one assumption and that assumption is counterintuitive, and it's basically conflicting with another assumption somewhere else. For instance, if we say that, hey, we are going to increase our sales in region A, without even knowing that the management is thinking of downsizing in that region, which means we are taking assumption that our sales would increase by, for instance, 10% during the year, without looking at the fact that a downsizing is expected in that region, or maybe something else is happening in that region which may not, which is going to impact our assumptions. So always look at interdependencies. Think through the if and then scenarios. If this happens, how it's going to impact. Imagine, I mean, we have been through this COVID, calamity, or this black swan event during the last couple of years. And who knew this event could happen? Again, that was a black swan event. But always think through, if this happens, how it's going to impact the business. If our assumptions change, our information change, if the business environment change, how it's going to impact the business. Do sensitivity analysis. As I said, it's a peek into the future. And if something changes, how it's going to impact the business. So sensitivity analysis is one of the most important things. Use predictive analysis. Again, I mean, they're all interrelated. Sensitivity analysis, if and then analysis, predictive analysis, they're all like connected together. But think through these ideas whenever you're creating your projections. The fourth pillar that I always want to talk about is technology. In these days, when businesses have grown global, they are huge organizations. with the advent of technology, we are working across the globe. It's not possible for to create your projections or forecasts without the use of technology. So use software as much as possible. Use standardization, as I said, and the software is something which helps with standardization. Cloud-based collaboration is very important. Use machine learning so that you don't have to create everything all the time, and you take help from machine learning techniques and AI. Use visualization and dashboards. There are multiple tools out there which are helping executives, which are helping finance team to visualize data and create dashboards which are more meaningful. So always use technology. That's the bottom line. Let me move quickly forward. So what creates a reliable projection? So reliability is the key, and for reliability, no matter if it's projection, it's anything else, there are a couple of factors that we need to always consider. Internal control processes, robust, strong internal control processes always lend reliability to whatever we do. And that's true so for our future projections as well. So if we don't have a robust process, if you don't have strong internal control environment, your projections may not be reliable. So always focus on internal control. Secondly, reliable technology. If the technology that you are using, it's not reliable. Every time you do something and due to a weak technological platform, things change, things are not saved the same way, the formulas are not correctly flowing through into your projections, problem, which means you don't have a reliable technology and you don't have reliable projections. Third element, documentation. Document everything that you do. Imagine a scenario where you come up with an assumption that your sales will increase by 10%. What is the basis of that? If you don't have enough documentation behind that, you'll not have a reliable projection. How did you come up with that 10% assumption? It has to be through a certain, an analysis, an insight from the executive team, a target set by the management. Where is it all coming from? So document. Document your KPIs, identify your KPIs, see how they are changing, how they are moving, how they are getting impacted by different factors within our business, and how they are sort of being utilized. So if we do that, our projections it'll lend credibility to our projections. Standardization, I already talked about a little bit. So a standardized approach goes a long way. But there is one caution which I always give. Please don't let standardize impact your innovation and your creativity. Because if everything becomes so mechanical, it'll impact your creativity. So have the creativity intact, but use standardization as much as possible. Finally, ownership. If you don't take ownership of your own projections or your own forecast, your budgets, who's going to do that? So you have to take ownership of your projections and your work. Once you do that, it'll lend credibility to whatever you are presenting. Never ever say that, hey, this number came from this team and that's why I'm putting it. Yes, it came from a certain team, but since we are responsible as finance leaders, we should take responsibility, and understanding that from our folks is very important. Lastly, I'll just jump quickly before I take questions. How to effectively communicate. Follow the stakeholder expectations. Every stakeholder is different, their expectations are different, follow them. Simplicity is key to anything and everything, and that's what's important over here. Consistently report metrics. Consistency is important. Risks have to be communicated. Be clear, that builds credibility, and always avoid jargons. So since we are already have got 5 minutes left, I'll quickly jump over to questions. Let me go through those and try to answer as many as possible. So let me look at the first question. So the first question is, how can finance teams effectively create and maintain crisis plans for cash management? It comes down to two things. Number one, your understanding of the business and what kind of crisis we are talking about. As I earlier said, we have to have a laser focus on operations. If our operations are throwing out sufficient cash, sufficient money, that will lend our decision making in terms of investments. So we are always keeping reserves. Those reserves have to be kept in a way that they can sufficiently provide us with buffers in periods of crisis. So short-term investment, long-term investment, look through where are you funding them from? Is it a long-term funding that you are is it a long-term finance which is funding our short-term assets? So think through all those things, and so define crisis, look through different scenarios, and based upon that you can take a decision. Okay, so the second question is, what tools or methods do you recommend for ensuring financial data is easily accessible to assessing cash flow accurately? There are tons of tools out there. I won't say there is a single one which is ideal, but always try to use different technologies, dashboarding techniques, data and analysis techniques. Of course, I won't name any specific tool over here, but try to make use of them as much as possible, be it data repository, online collaboration tools, your cloud-based tools. They are very important. That will definitely help. So our third question is, in a manufacturing setting where new orders are processed and shipped within a week time frame, how far out should a cash flow be forecasted? Is 30 or 60 days sufficient? Okay, so it's a tricky question, because we are saying that it's a 1 week time frame. How much cash should we be keeping so that if something goes wrong? Well, I mean, in that case, 30 days is a good time frame, 60 days is a good time frame. But and since this is only 1 week cycle, so look through both the elements, the P2P element and order to cash element as well, and marry them together. See if it is only like if you're looking only at the P2P cycle, it won't complete the picture. Look through the order to cash cycle as well, marry them together. That will give you the right answer, that how much cash you should be keeping, and that will be sufficient. Let me look at the other question. How can finance professionals effectively communicate financial data and numbers to stakeholders to demonstrate the value of investment? Well, I mean, this is something that I quickly touched upon. Use technology, keep providing information on regular basis. Use KPIs that are relevant for them, and don't add jargons. Keep it as simple as possible. We talked about that. Let me jump over to the other question. Are there any common pitfalls, the challenges that finance team face when managing cash flow, and how can they be overcome? In my experience, the biggest pitfall that I saw was using extrapolation, which means we are not seeing through the future. We are not understanding the business. If you don't understand business, if you don't understand the business environment, whatever cash flows, whatever we create, it's not going to lend credibility, and it's always going to come back on our faces. It's unfortunate, it happens. So I would always advise, go sit with your business teams, understand the business, understand the different, go a bit deeper into your business understanding, and only then you'll be able to create a good cash flow forecast. Look through your assumptions. Your assumptions should not be based upon your own judgments that, oh, I'm going to just add my sales by 5%. Let's tweak my cost of sales to this percentage, and that will throw us a good number. A good number is that number which is backed by reality. So search for that reality while talking to others. Perfect. And yeah, so we are already at time. We've got a couple of questions coming up, but I think in the interest of time, I'll pass it back to Nick. Nick, thanks a lot. Over to you.
Well, thank you again, Nayab, for such an incredible keynote. And I want to thank everyone else for joining us today. This session, along with all of today's content, will be available on demand following the event. Our next session will begin at 2:05 p.m. Eastern Time, which will be a panel discussion titled Finance Transformation 101. Please click on the join button that will appear on your screen to be redirected to the next session, and we look forward to seeing you there.